Okay, so in this video I'm just going to go through some of the points about lqua securities and how it works. It's probably about a 5-minute video. We start with the concept of an asset, which is something that will produce some sort of income, and that's really what we mean by an asset. And then we have the concept that a company owns that asset. This is called an asset-backed security, and in this example the company will own all of the asset, 100% of the asset. The company itself, of course, then has a structure, and in the structure it's got shares, and the shares are then owned either by individuals or other companies. So we go through this example here. We will say investors will purchase these shares, and then the question is, well, who do they purchase them from? Well, they'll purchase them from the original asset owners, and the asset owners will be the people that acquired the asset through some mechanism, such as could be borrowing money, could be a construction which falls outside of this, but they own the asset. They can create liquidity for themselves by having a company which owns all those assets, and that is then has a share structure. And these investors, when they buy these shares, will also agree an option with a company, which will become clear later, to why you might need to actually have a liability for the company in terms of the value of these shares at a later period. So what we want to do with small caps is create liquidity. This means that if somebody put in, say, £1 million into a company, they've lost that £1 million, they can only get the money back if the company is sold, and other than that they just get dividends, which typically, even a good company might pay 10%, typically it will be much less than that. So it means that at the end of the day the investors lost liquidity, and this is very expensive. So we want to try and create liquidity around this small cap, and this solution will convert the shares into tokens. It will tokenize the shares. If we have something worth £1 million, we'll get 1 million tokens. And this means that the people that own the shares also have these tokens, and there will then be, this is a form of financial instruments, and those tokens will then have rights over the shares, which in turn have rights over the assets or the company. So if we move on to what we'd want to do with these tokens, we want to take the token fund, which is this fund here, and we want to join it to a mutual fund. It's called an open-ended fund. So the fund can grow. These are the investors in the mutual fund. They will vote based on the worth of the underlying asset, which this token fund has rights over. So the token fund, through the investors, will make a join request, and they'll come back with an offer. So they might say, you're saying it's worth £1 million, we think it's worth less than that, 900,000, and the token fund either accepts or rejects the offer. At a point of law, if they don't accept it, the offer will automatically lapse, and they would have to either come over the counter offer, which then starts a cycle of negotiation. If we then say, well, once they've accepted, what does that mean? We have got a liquid fund of 100 million tokens. We've diluted the 1 million down to 900,000, so we get 100 million plus 900,000. The beneficiary now is this new fund, and so this fund has grown. It's grown by the amount of this after dilution. So once we've got to this point, we've got a larger fund which is then more liquid, and then these investors will join the mutual fund investors. And then we have a situation where the original token investors have lost some money due to dilution. They have to go back to the executives. These executives have a fiduciary duty, which means that they're basically managing these assets on behalf of the company, which has this share ownership, which of course then relates to the tokens. So what will then happen is the executives will have to pay back under an option some of the money to the original investors. Bearing in mind that these executives were the people under this arrangement, or if they did have investors, the investors behind them would have benefited from the original money that these token holders had put in this example, £1 million. So £1 million has already gone into these hands here. So under this agreement, they're paying back 100,000. They still get 900,000 on the basis of these assets. And the reason for that is the assets have been devalued in effect. And when this is negotiated at the point of selling the shares, these executives here would put in minimum and maximum, and they also, this contract would be subject to a legal test anyway. So if these investors deliberately defrauded these executives by going into the fund and agreeing paybacks from the fund which were not reasonable, would be the legal term, these executives here could take that to court and they could have a legal test to verify it. So these executives do have options, legal options open to them to challenge this, but by and large it's the cost of capital. So if they have an asset they think is worth £1 million, but the market really says it's only worth 900,000, then they simply have to accept this loss, because that's part of the market dynamic. And if this company is successful, they can also put in their own options to buy back all the tokens and all the shares if this is successful, guaranteeing these investors a certain return and guaranteeing these executives all of the assets and all of the shares back into their hands. So that would be the construction which would enable everybody to make profit and to compensate that through risk. Once the to balance that through risk. Once we've got the asset model here, the customers obviously have whatever service is being offered here, they will be paying the company behind these assets. That will provide dividends to the fund, the liquid fund, and that pays dividends to the investors of the fund. And the fund itself can then, or the tokens can then be traded, which is your liquidity option. You can get derivatives, these would be debt instruments typically, and you would have options. So these would all be different financial instruments here based on the original fund. So if the fund had 100 million and it had a certain performance, you can then go into the market and you can create further liquidity, because these investors here have, again, although it's a liquid fund, the investors have actually lost liquidity. So they can change that by reducing obligations here, so that they can actually, for example, borrow on this fund, create a derivative. Money would then go in to the investors through this environment, this contractual environment, and then the investors would get back, say theoretically, say 70 million of the 100 million, and then you have a liability structure. So the dividends would have to keep coming in, and if there are defaults, the debt instruments, the contracts there would take those losses, and this would be tiered. So that's one possibility. These options again refer to investors buying back. So if we had an option for the executives to buy back the shares, that would go all the way up to the liquid fund. So there would be an option at the time of joining the fund that you could withdraw, and the terms of withdrawal would be stated. So in this way you maintain liquidity, you are maintaining risk in terms of a balance for what rewards you're actually getting. So that's the summary of the lqua securities model, and that concludes this video.